I'm Sarah, a tutor at Accountancy Learning, and in this video I'm going to be going through Financial Accounts Level 3 AAT Sample Paper 1 Task 5. Now this task is all about accounting principles, quality of useful financial information, and interpreting financial statements using profitability ratios. So let's have a look at the first question we are given. So in this first question, we need to identify the principle being described in each of the following scenarios. Now in the exam, you've got a drop down and you've got the options from your drop down here. So we've got accruals principle, materiality, going concern principle, accruals principle and going concern principle, and business entity. So let's look at the first scenario then. So value of goods sold but not yet paid for at the year end is included in sales for the year. So we've sold some goods but they haven't yet been paid for at year end, and we still include them in the sales for that year, for that financial period. So that's about matching our costs and revenue to the period in which they relate. So that's going to be our accruals principle. The second one then is Rena owns a greetings cards business. When she takes a card for her own use, she records this as drawings. So remember, when we're talking about business and we're talking about owners, when they are separate and therefore all the transactions are included as drawings, so whenever they take something out of the business, it's included as drawings, that means we're keeping their personal and their business separate. So that means we're going to be talking about the business entity. Principle. And what that means is that the business is an entity in its own right. So anything that the owner does still needs to be recorded through the business. So anything put in will be recorded as capital, anything taken out would be recorded as drawings. Stationary items such as staplers are treated as expenses rather than non-current assets. So here we're going to be talking about the value of something. So when you are recording a non-current asset, it's normally based on a policy of capitalisation within the business. So a particular item over a certain value would be able to be put on the non-current asset register and then depreciated over time. But stationary items such as staplers, which may cost a very small amount, wouldn't be classified in the same way. They are just expenses to the business in that period. So that is going to be talking about our materiality. So materiality is concerned with whether it is a large value item that is going to have a significant impact on the accounts. So your stationary items that go through will go through as general day-to-day expenses. And then the last one is non-current assets are depreciated. So when we're looking at non-current assets and the depreciation on them, let's have a think about what depreciation means. So the depreciation is matching the cost of that asset over its useful life to the month or year in which we are recording. So based on that, we can say that it is the accruals principle, because we are saying that over the course of this year, we're spreading the cost of that asset. However, because there is a useful life of the asset, if that asset is still there at the end of the financial year and it is still projected into the future over its useful life, it means that that is also showing a going concern. So going concern for the business is that the business is likely to continue. So if we've got assets going past the year end date, then that is a sign of going concern. So therefore the business is continuing. So for that one, we would be looking at accruals and going concern principles. For the next one then, we are then asked to identify each of the enhancing qualitative characteristics being described below. So the first definition that we're given is when knowledgeable and independent observers can reach a consensus that the information is faithfully represented. So again, you're going to be given a drop down in the box and we've got our options to choose from here. So a common mistake I think that happens with this question is everybody jumps to looking at faithfully represented and think that that's the answer. When you are having independent observers reaching a consensus, it means that they are actually verifying that that information is true. So you've got 2, 3, 4 or more people having a look at the information that's been given, and all of them can say that it's true. So therefore, we are going to be looking at verifiability. So can we verify that that information is faithfully represented? The second one, when information is clearly and concisely classified, characterised and presented. This does not mean that complex information should be included. So when we're looking at this one, the key terms here are going to be the clearly and concisely classified. So when we're doing something that's clear and concise, it means that we're going to be able to understand it. So our characteristic here is going to be our understandability. If the information was given and it was very complex and it was very messy, it'd be very hard to understand. But when it's clear and concise, it means it's going to be understandable. In the next question, we need to identify whether the following statements about profitability ratios are true or false. So the first one then, the interpretation of an entity's financial statements using ratios is only useful for potential investors. So yes, absolutely, investors may use ratios to understand the financial statements and maybe help make a decision on whether they will invest in the business. However, the ratios are actually also good for the management and owners of the business. So it can both be used by potential investors and internal management and owners. So therefore, it's false because they're not only useful for potential investors. The second one, in order to provide useful information, ratios need to be compared to different organisations, different time periods or different industry standards. So absolutely, this is true. So ratios are a snapshot in time of performance. So it's all very well being able to say, the ratios are this at this particular time, but what does that actually mean? We need to be able to compare it against something to understand whether there's been an improvement or a decline in that ratio, and therefore what does that mean for the business? The third one is a disadvantage of ratios is that they are based on previous performance, which may not be valid for making predictions about the future. And again, this one is absolutely true. So as much as the ratios do give us useful information about how the business has performed, that doesn't necessarily mean that that is going to be how it's going to perform in the future. There are lots of different changes that can happen. It can be internal and external changes that may affect the business. So it could be that the ratios from the information from the past isn't always reliable to understand what might happen in the future. And then finally, all other things being equal, if gross profit percentage increases, then net profit percentage will decrease. So if everything stays equal within our expenses and our income, and we've got a gross profit percentage of, say, 20%, then our net profit percentage is still going to stay the same because everything is still equal. The income is going up, the expenses are going up, or vice versa. The income's coming down, the expenses are coming down. So therefore, that one will be false. Moving on now to part C, we are given some information about an organisation here. Now, we need to calculate the following ratios based on the information above. And importantly, we must give our answers to 2 decimal places. So we've got our return on capital employed, and we've got a net profit margin. So we need to work out the percentages for both. So our return on capital employed. So this is about what is the return on the money that's actually been invested into this business. So for that, we're going to need a couple of different things from the information given. So we need to work out what has been invested. So what has been invested is our capital. And we're also going to have a look at our non-current liabilities. So let's highlight both of those. Now, the return is actually going to be what have we made? So what profit have we made? So we're going to be taking into account our profit figure. So the first part is we're going to be adding together our capital and our non-current liabilities. And then we'll divide that by our profit and then multiply it by 100. So we will have so we're going to add those 2 together. And then we will divide it by our profit and multiply it by 100. And that gives us 25.29 to 2 decimal places. So our next one then is our net profit margin. So for our net profit, we're also going to be wanting to look at our profit or loss for the year. So this is about how much profit versus revenue have we made. So we're also going to want our profit for the year, but we're also going to need our revenue figure. So we are going to divide our profit for the year by our revenue, multiply it by 100, because don't forget that's what gives you your percentage, and to 2 decimal places that works out at 13.96. Now we're given another true-false question to answer. And we need to identify whether the following statements about the rise in the ratio are true or false. So the first statement is the rise could have been caused by the business taking on a new person in order to stimulate growth. So this could be true. So if the business has taken on more staff, then it means that the wages are going to be a higher percentage against revenue. So more wages have gone up, and then it will take time to tell whether the revenue is going to go up. So they've taken on more staff in order to try and stimulate growth in the business. So therefore, that would be true. The second one is the rise could have been caused by revenue rising during the year due to increased advertising, but no extra staff were employed in the shop. Now, this is the opposite of the previous statement. So the revenue has already risen due to a successful marketing campaign, but there hasn't been any change in the wages. So if no further shop staff are employed, then the wages wouldn't rise. And if the revenue goes up, then the shop wages would actually be a smaller percentage rather than a larger percentage. So that one is going to be false.